Well, the big news I want to say is, we're doing great on the inflation front. I mean, inflation is coming down now in many countries, getting close to inflation targets. And we've done this without having a major slowdown. I mean, we're projecting growth at 3.2% in 2024, it was 3.3% in 2023. 3.2% again in 2025. So very resilient global economy and this inflation coming down. So we've almost achieved the smooth landing at this point. And so what that means is now central banks can start moving away from a narrow focus on inflation as the core part of their mandate, and they can start thinking about, okay, well, we're almost there, so now let's make sure that this economy remains stable. And we've seen that pivot on monetary policy by the Federal Reserve, we've seen it by the European Central Bank, the Bank of England. Major central banks have moved in that direction.
We have spent so long talking about the last mile of inflation and whether policy reignites inflation at some point. However, just in recent weeks, we're getting more and more market commentary about the risk of undershooting on inflation. And in fact, for central banks, it might be a race against time to get back to neutral. What do you make of that assessment?
Well, there is indeed a risk that if central banks were to keep interest rates high for too long, as inflation comes down, then that would weigh down on economic activity, that would lead to rising unemployment, and at some point it could threaten growth. And so central banks have to be relatively careful about this. This is why I think they're keeping their fingers on the pulse. They are telegraphing that they've started cutting, they will continue cutting rates so that we can achieve that smooth landing. Now, this is in an environment in which there are a number of risks that we have to pay attention to. You mentioned the August little turbulence in the market. That's a reminder that sometimes things can tighten up very abruptly, and we should not assume that everything will be smooth. Geopolitical risks, the tensions in the Middle East, the rise of geoeconomic fragmentation, trade tensions. So we are seeing a lot of these risks are still on the horizon. They are becoming maybe even more important. And you mentioned China. Now, the government has announced a number of measures, but this is in the context of an economy that is doing not as well as we were expecting back in July. We revised down our projection for China to 4.8% for this year.
China is in fact one of your downside risks that you state in your Outlook report. Further real estate price declines, such as what we witnessed in Japan in the 1990s, US in 2008, denting consumer confidence with spillover effects to developed and emerging economies. This was a comment from your report. The caveat, if not addressed, is China addressing the problems? Are you more confident after what we've heard in recent weeks?
Well, we've heard a number of measures were announced, some of them at the end of September by the People's Bank of China, Chinese central bank, and we've incorporated those in our forecast. They're certainly going in the right direction, not enough to move the needle from the 4.8% we're projecting for this year and 4.5% for next year. Since then, the Ministry of Finance has announced another raft of measures directly designed to help the property sector. We are still assessing, we have to see the details. These are not part of our projections, so they could provide some upside risk in terms of output, but this is in a context in which the third quarter of Chinese economic activity has disappointed on the downside. So we have this tension between, on the one hand, the economy is not doing as well, and then there is a need for support. Is there going to be enough support? We don't know yet.